Sellers continue to pound U.S. West Texas Intermediate and International benchmark Brent crude oil futures early Thursday after a government report on Wednesday showed gasoline demand fell and the rising number of COVID-19 cases pointed toward a slowing global economic recovery. At 9:02 GMT, October WTI crude oil futures are trading $40.81, down $0.70 or minus 1.69%. And December Brent crude oil is at $44.16, down 71 cents or minus 1.58%. Today's sell-off is a follow-up to yesterday's plunge that saw both benchmarks falling more than 2% with WTI sliding to its lowest close in nearly 4 weeks. Brent is currently trading at its lowest level since August 3. Both futures contracts changed their trends to down according to the swing chart technical indicator. The weekly report from the U.S. Energy Information Administration released on Wednesday showed U.S. gasoline demand last week fell to 8.78 million barrels per day (BPD) from 9.16 million BPD a week earlier. Crude oil inventories fell more than expected the week ending August 28, but investors shrugged off that data due to the impact of Hurricane Laura, which likely skewed the results. Meanwhile, the focus remains on demand for gasoline and distillates. The Energy Information Administration said on Wednesday that crude inventories fell by 9.4 million barrels in the week ending August 28 to 498.4 million barrels, according to the data compared with analysts' expectations in a Reuters poll for a 1.9 million barrel drop. The decline was driven by a record fall in production, which dropped by 1.1 million barrels per day to 9.7 million BPD, its lowest since January 2018. As most U.S. offshore facilities were shut as a precaution ahead of Laura. Gasoline stocks fell 4.3 million barrels in the week, the EIA said, compared with expectations for a 3 million barrel drop. Distillate stockpiles, which include diesel and heating oil, fell by 1.7 million barrels in the week versus expectations for a 1.4 million barrel drop, the EIA data showed. Traders are primarily ignoring the headline numbers and focusing on the internals of the report. As mentioned earlier, the key market driver is the plunge in gasoline demand. But in addition to that, refinery runs fell by 844,000 BPD, and refinery utilization rates fell by 5.3 percentage points to 76.7% of total capacity, the EIA said. Product supply, a proxy for demand, was lower as well, which may restrain refiners from ramping up production. There is nothing oil companies can do to ramp up demand, but they can delay any plans to ramp up production. OPEC, on the other hand, may have to revisit its plan to increase production if prices continue to fall. The markets could become range-bound again over the near term, but at much lower prices. In other words, the old bottoms for WTI and Brent are likely to become new tops.